Today we are very happy to have Mr. Chen Fan Fai, Director of Investment of Kenanga Investor Berhad, to be with us. Mr. Chen, welcome to PhillipCapital. I understand from Kenanga that actually the unit trust funds are divided into two teams, right, of two different styles, so that offer the investor more choices.
Yes.
So can you please elaborate what is your investment style and the philosophy?
Okay. Basically, you can say that we are team 2 equity in Kenanga investors. Okay. Our philosophy is very simple. Basically, we look for companies with good businesses that are well managed. What we actually do is actually look for businesses with sustainable, or better yet, growing ROEs, okay, which are trading or being offered at a discount to their so-called intrinsic values, right? So why ROE? Because we believe that ROE is a suitable proxy for business success, okay? And ROE also basically is a measurable distillate for the 4 key processes of any business you look at, be they the strategy, the business strategy itself, the processes of the businesses, whether operational or financials, the people, and of course, lastly, very importantly, is the execution capability. So with this ROE, it's an indication to the common shareholder actually how their invested capital has performed, okay, over any period of time. Basically, that's what it is. Yeah. So that is the gist of our philosophy, and we apply this philosophy across all the funds that are managed by Team 2.
Okay, so as a guide,
yes,
roughly what are the targeted ROE you are looking at? Let's say, is it 20% or 25%?
Okay. We do not have a specific ROE target. The key word that we talk about here is sustainable ROE, or better yet, sustainable and growing ROE, which are trading at a discount to their intrinsic value, right? Because our belief is that, of course, different businesses in different sectors have their own different, will generate different profitability in terms of ROE, right? But as long as they are sustainable or growing and is trading based on our DCF at below their intrinsic value, we will consider them. But I would say that, okay, as a first cut, normally we will only look at business. As a first cut, we will only look at businesses where the ROE is above the ROE of the market as a whole, and then from there we slowly goes down the scale.
Okay, and in that context,
yes.
In that context, you're looking at comparing ROE and using DCF,
yes,
and try to identify the intrinsic value of the company,
yes,
that whether you want to invest or not. So, in a very broad way,
yes,
will you put yourself as more of a growth investor or a value investor, or somewhere in between?
I would have to say that we are style neutral, because if you look at our portfolios of the companies that we have companies with ROE as high as 30-40%. We also have a company of ROE of 10-12%. And obviously, they all come at a certain price, depending on the growth rate. But if I were to look at my portfolio now, I would say that I would have a bias towards the value side.
Of course, that will change according to the market condition, right? Or it's always more tipped toward value.
So far, in the last 4 years that my team has managed the retail funds, okay, it has been quite consistent that we have a slight bias towards value investing.
Okay. So, on the context, your fund has been performing very well.
Yes.
So, what about on the managing risk side? I mean, what are the measures or the process, right, that you have in managing the risk and also the volatility of the fund?
Okay. Actually, risk management is one of the key components, I would say, of our investment process, one of the major key component. And if you look at the funds that we offer to the public from Team 2, the risk level is actually significantly below the market and also our peer group, right? And the reason is because, okay, what we do is that when we construct the portfolio, which is basically from a bottom-up basis, on a stock-by-stock basis, each time we introduce a new company into the portfolio, we evaluate the whole portfolio and study it to see how it will behave under different market conditions. And when we say we study, what we mean to say is that how much would this new addition contribute to the volatility of the overall portfolio. And for us, in general, every portfolio we construct, we want the portfolio to have a volatility which is below the market.
Okay, so looking at the return,
yes,
right? Your fund over the last 5 years,
yes,
has been performing at about 15% per annum.
Okay, yes.
Right. So looking forward, do you think this is a very sustainable and achievable target if the investor were to invest into your growth funds?
Sustainable. Okay. Let me just qualify that first. Okay. What I can say is that from our past 4 years experience in managing this the funds, these retail funds, we have consistently been able to achieve return, I think easily 4-5% over the market benchmark, which in the local context is the KLCI, right? So to answer your question now is, if we assume the market, KLCI can do say 10% a year per annum over the next 5 years, then I would say that we are reasonably confident we can do better, 10 or better, based on the past 4-5 years that we have been managing these funds. Yeah. And I suppose if you were to ask me further as to whether, let me see, whether the market can do 10% per annum or not over the next 3 years, let's say, all I can say is that for this year and the next year, we are reasonably comfortable. Our house view is that the earnings can grow. For example, this year around 15%, next year probably somewhere around 10 to 12%. And given that the valuation is still very much within this long run average, we would think that the share price should track the earnings growth. And translated meaning, this year we're looking at somewhere in the big teens, next year somewhere in the lower mid-teens, lower single double digit, right? Yeah.
Okay. So, I mean, you have been managing very well on the both local funds.
Yes.
Any plan in the future to launch at least regional or Asia Pacific funds from your team?
Definitely. Actually, this is a project that we have already started on already, and I would say that if everything goes well, we would like to have it put out into the public space before the end of this year. In fact, for our management style, in terms of investment philosophy and process, it works even better when we have more asset classes or even markets to invest in, because when you have more markets and more asset classes, they are less correlated, and therefore we can actually control the risk of, in terms of this sense, volatility far better actually. Yeah. That's why I'm actually quite excited about that.
Okay, very good. So in that context, currently, right, looking 3 years, let's say investment horizon of 3 years,
yes.
Do you think the investor should be a little bit more aggressive in equity, or just stay about moderate, like about 60-40, 60 equity, 40 bonds, or they should increase their exposure in the equity side?
Right, okay. We're talking about generally, not specifically. Okay, anyway, what I would say is that economically, we are at probably into the second year of the recovery, and the economic data that comes out, okay, seems to indicate that the recovery is sustainable. Or from time to time, there's a blip and it causes some volatility in the market, but overall we would say that this recovery looks sustainable, maybe uneven. Certain region will grow better than other region, right? And in tandem with that, corporate earnings also, probably in the second year of its recovery, and our view is that this recovery is still at a very early stage, and maybe by next year moving into what we call the steady state, and that steady state can actually last for the next 2 to 3 years quite easily if you look at the economic cycle. So from that perspective, I would have to say that if I have to choose financial assets between equity or bonds, I would definitely say equity will do a lot better over the next 2 to 3 years.
So what are the possible risks that can derail your current projection or current scenario?
Okay. That is the blue sky, I would say. But there are many external headwinds. Let's be honest about that, right? Of course, even when you invest, you have to be very careful. One of the many headwinds, of course, we all know is the inflation is rearing its head already. Okay, but at this juncture, we are still not so concerned, okay, as long as the growth is still very much intact. Yeah. Now, the other part is the concern on the growth part. Okay, what would happen when QE2 ends? Okay, or even at in the Europe side, the sovereign debt crisis. What happened if it blows up, right? So all this could actually cause the global economy to actually slow down, right? But our belief is that, like I said earlier on, if you look globally, the economy is on a sustainable path, but unevenly. Okay, when I say unevenly, what I'm trying to say is that on the major economy like the US and Europe, okay, when we do our investment, we are not factoring them as growing as any. They are growing at a very anemic pace, we would say. Whereas on the emerging market side, in particular, more on the Asian side, okay, we think that the growth rate will be in the, I would say, at least at the mid single-digit level. So it is very important when you construct your portfolio to bear in mind that you would not want to have any investment whereby the exposure to this external risk of a slowdown from US or Europe. Because like many studies actually have shown this process of deleveraging, which is what balance sheet deleveraging, which is happening at the household level, at the private sector and the government sector, it will take years to unfold. And I think we are only at best second to third year into the whole process, and the whole process can probably take 6-7 years. Yeah.
So, in summary,
yes.
For an investor to look into your funds,
yes,
what are the key points that you think investors should look into and probably consider whether they should invest in your fund or not?
You see, the way it's very important that investors understand the way we run the fund, right? Okay. For us, the fund, if you notice that we don't shoot the lights out in that sense. We are more of the middle of the path road. For us, risk management is key. We try to keep our fund as stable as possible for our end investors, but yet try to achieve a return which is on par with what the market can give, right? So coming back to where I said the economic picture is, we are actually at the early phase of recovery, probably moving into this so-called steady state. And our investment philosophy actually does very well during this stage, simply because we are this bottom-up stock picker, and at this stage of the cycle, stock picking is very critical. For example, whereas at the earlier phase, where first year of the recovery, whereby it's still what we call twilight zone, right? Yeah. So if you guess it right, if you're aggressive, you can do incredibly well. But that is not our style. And if you track back the performance of our fund, you will have noticed that, for example, when the market spiked up in 2009, we didn't do as well actually, to be honest. But over a full business cycle, we will do well.
Okay. I think with this, investors should have a better understanding of funds managed by you, which is the Kenanga Growth Fund and the Kenanga Growth Islamic Fund. Yes. So thank you very much, Fan Fai, for helping investors to understand your funds, and we look forward to see you again.
All right, thank you.
Thank you.